Okay, in Chapter 14, we also talk about partnership liquidation. Dissolution is when ownership changes because, again, it doesn't have continuity of life, so any change in partnership composition means dissolution of the existing partnership and reformation. That can be transparent to the public and they don't know a thing because it doesn't change the actual business function. Liquidation, on the other hand, means operations cease and the partnership ceases doing business. So while you don't have homework on this, I really would encourage you to work on the threads on the concept of liquidation because it's an important concept as well. And I want to demonstrate one example of a liquidation problem. So using exercise 9, you'll see the top part starts off with what the partnership had at the date that it decides to liquidate. So they had cash, some non-cash assets, liabilities, etc. Now when we get to this stage, any partner loans are combined with capital balances based on the right of offset. So you see the title has that, and you see that Moore's deficit balance is reduced by his outstanding loan because those get combined because they're still partnered, they're not outside creditors, and that comes together. The goal in liquidation obviously is to protect the creditors first and foremost, and then to protect the partners so that one partner doesn't benefit while the others suffer. So in this particular example, what happens to begin with is assets with a book value of $30,000 are sold for $20,000. It means we're going to take $30,000 out of non-cash assets. We're going to take that $20,000 that we got in cash. We could put it here in cash if you want, but that $20,000, the cash that's available, is going to be used to pay creditors right away. So we're going to just take that out of liabilities. And again, if you consider this as the accounting equation, actually if I go ahead and I add a little formatting in here, you can see the two halves of the accounting equation, assets on this side and liabilities and owner's equity. The two sides of the equation have to balance. Well, right now they don't because it's 30 and 20. That means that we lost, it's a loss on sale, obviously, of those assets. That loss has to be allocated to the partners, and it's going to be allocated based on their profit and loss sharing percentages. So we're going to take the $10,000 and allocate it based on those amounts, and then both sides of our equation again are in balance. So then our next step is contribution of personal assets. As you read in the problem, obviously we have two partners that are very close. One is in deficit and one is very close to deficit. So we have to look at the potential of what can they kick in personally. They're on the hook personally. Well, Moore is the one especially that we need to get to a zero balance. Right now he owes the partnership. Well, if we look at Moore, his personal assets less personal liabilities, he only has $9,000 to kick in right now. So we're going to go ahead and contribute that $9,000 and put it in cash. We could also reduce the liabilities, but we'll put it in there for now. And he's still negative. The other partners may potentially have to kick in for him, but he's contributed what he can at this point in time. Then it says shortly thereafter, assets with a book value of $20,000 and a fair value of $23,000 are distributed to Coleman. So what happens here is we're going to take out the $20,000 from the non-cash assets, but Coleman is actually getting value that is in excess, so that $3,000 gain, if you will, has to be allocated to the partners. So if we took the $3,000 times their profit and loss sharing percentages again, Coleman would get $1,800, Moore would get $6,000, and Ramsey would get $6,000. Now the other thing though that we need to do with Coleman is Coleman in essence pulled out something that had value or got a distribution, if you will, of $23,000. So his net distribution is $21,200, and the other two partners got the allocation of the gain on that asset that Coleman took out. And the reason Coleman can take something out at this point is because he has such a large balance and because he is the primary risk partner here with the 60%, therefore he can take a distribution. We could have gone through a schedule of safe payments and it would have proved it. We'll do one of those in a little bit here when it's a little tighter. But in this case, we had to make sure that Coleman was not harming the partnership or the other partners, and he was safe doing that. Okay, then our next thing is we had some additional non-cash assets with a book value of $40,000 are sold for $54,000. Well, since the 54 is more than our liabilities, let's go ahead and put that there. Again, now you'll see that there's a gain of 14. That 14, again, keeping both sides of the accounting equation equal, has to be distributed to the partners based on their profit and loss sharing percentages. And then we're going to need to pay off these liabilities. So that's our next step. So we're going to go ahead and get rid of the rest of the liabilities, and we have sufficient cash at this point to do that. So now we have no liabilities, creditors are safe, but we still potentially have some non-cash assets here that may or may not be worthless. So before we distribute anything to the partners, we have to make sure. You'll also notice that as a result of that gain and distribution to Coleman, Moore is in a positive position, which is incredible, because otherwise the other two partners would have to kick in and potentially then seek restitution in court against Moore. So before we do any distributions, we're going to do a schedule of safe payment. Like I said, we could have done that earlier with Coleman, but because of his risk position, he was more than safe. So at this point, we look at their combined capital and loan balances again at the point in time that we are. So we're going to just copy those down, and we see that there's $34,000 in equity. And then we consider what is the maximum loss possible. Well, the only thing that's still possible is this $6,000, right? So if we got absolutely nothing for that, that's the maximum loss that could possibly occur at this point. We're going to take that and again distribute it based on profit and loss sharing percentages. And after absorbing that maximum loss possible, that means whatever is left is the safe payment that can potentially be made to that partner. So you'll see here that because Ramsey and Moore have much less at risk, there's not much they can take out. Okay, Moore especially is very limited, but Coleman can because he has the greater risk both in terms of the capital invested as well as the profit and loss sharing percentages. So the distributions then of this $28,000 in cash are going to be based on what is available down below. So we're going to take the $28,000 in cash out, and again we have to have it equal on both sides of the equation, and we calculated our safe payments. And so now you'll see the $6,000, same as the line down below, is all that's left. They may get an additional distribution if those have any value upon sale, or this may be the end of it. And hopefully that gives you a good idea of a liquidation example.